Hello, in this video we'll talk about non-recognition rules, the general concepts. There's lots of non-recognition rules throughout the Internal Revenue Code, and this video will serve as a general introduction to what exactly is a non-recognition rule and how does it fit into the scheme of the tax code. So first, I want to emphasize that when we have property transactions, well, again, as mentioned in previous videos, the Internal Revenue Code does not define the term property, but through the case law, property is very broad. Includes intellectual property, a thought that's not tangible. Property, very broad, important to understand. So property transactions are transactions that involve property. Specifically, what we've been looking at are sales and other dispositions. So sales and other dispositions. And when we had a sale or other disposition, we talked about how we have to determine the amount of realized gain or loss. And that's the first piece of the property puzzle. The first thing we determine when we have a sale or other disposition is what is the realized gain or loss. The realized gain or loss. Important to note the term realized. So if you recall, to determine realized gain or loss, we have to take the amount realized minus the adjusted basis. So the AR minus the AB. And that gives us realized gain or loss. So AR minus AB, amount realized and adjusted basis, those were defined in other videos. And that gives us the realized. That's the key word. The realized gain or loss. Realization, if you recall from the gross income videos where I talked about the three elements required for gross income to be present, definition of gross income, there must be an accession to wealth, which means your net worth has increased, clearly realized, and diminished control. So the realization element in having a sale or other disposition deals with realization and severance, which is a concept, an economic event that provides for the timing of when we actually record a gain or loss. So what we're talking about here is, let's say you own stock. You buy the stock for $1,000 and after a year, the stock goes up in value to $1,500. Should you have to record that $500 increase in value at the end of the year? No, because no event has occurred. But what if you sold that stock at the end of the year? Then yes, because you have an event, a realization event. And that's what the sale or other disposition, that's the event that we're talking about with property. Other disposition is very, very, very broadly defined through the U.S. Supreme Court in cottage savings. Very broad definition of other disposition. So you can take a look at that case. So once we've looked at the realized gain or loss, that's not the end of the day what goes on the tax return. The next thing to consider is what is the recognized gain or loss. The recognized gain or loss on the transaction. The recognized gain or loss, this is very important. Recognized amount is what actually goes on the tax return. So if you have a recognized gain, that's what's going to go on the tax return. If you have a recognized loss, that's what's considered under the loss limitation rules. See the previous videos discussing loss limitation. So recognized is what matters for the tax return and for other considerations. So why do we have this concept of recognized gain or loss? Well, it goes to the idea of severance. If you recall from the previous video, severance is where you have a severable or separable item from the item that produced the income. So for example, when you have that stock that you bought for $1,000, I mentioned earlier at the beginning of the year, and it goes up in value to $1,500. Well, there's no severance because you still just own the stock. But what if you sell the stock for cash at the end of the year and you get $1,500? Well, you can separate out that money. You can separate the $1,000 that you initially spent on the stock and the $500 of gain or profit that you've incurred or you've had that resulted from owning that stock over that year. So you can separate those out. So it's all about what you can separate. There are certain transactions in tax that there's really no severable event, even though a sale or other disposition has occurred. An example, a like-kind exchange. What if you trade some real property, some land you own that you're holding for an investment? Maybe the land is in a downtown area, and you trade that land for land that also is going to be for investment purposes on a river, and both are worth a lot of money. And that's all you do. You trade land for land. Well, another disposition, under the definition, would encompass an exchange. And again, because other disposition is so broad, guess what happens? Yes, you've traded land for land, but they're two separate types of land, and they're not the same identical asset, so therefore you have a sale or other disposition. So we calculate the realized gain or loss, the amount realized, which is the fair market value of the land you receive, minus the adjusted basis of the land you give up, and that gives you realized gain or loss. But is it appropriate to actually recognize that? Because if you think about it, you have land before, you have land after, and they're both similar. They're like kind. And we're gonna and if you look in future videos where I talk about like kind exchanges, it'll make more sense. But just take my word that economically, you don't have any separable item. Economically, you're still the same. So if you recall from our tax policy discussions in previous videos, one of the elements is efficiency. We want a tax that is efficient. A tax that's efficient, which deals with the economic considerations. We do not want to incentivize certain taxpayers from doing a transaction or not doing a transaction just because of tax. That's the idea. Well, the like-kind exchange is what this is all about. It's not only about going at the severance issue, which that is an issue, but it's not that clear. But it's definitely about efficiency and economic policy. We want to encourage businesses and investors to trade property without having to potentially pay tax, and then because they having to pay tax, they won't do the transaction. That's bad. Because other than the fact that economically the taxpayer was in the same situation before and after, they still own the same type of land, right? It's still worth the same amount because they've exchanged it, land for land. Another issue is cash liquidity. Think again to our example. You trade land for land, and you're an investor. Both are held for investment purposes. What if you don't have any cash to pay the taxes? What happens? Guess what? You have to pay the tax if we don't have some type of mechanism in place that stops it. And you're probably going to have to sell the land that you acquired, get some of the proceeds, maybe buy some smaller land to pay the tax. So you're thinking, well, why would I even do this transaction anyways? I'll just keep my downtown land. This is not good. So again, this really shows the basic points of why we have non-recognition rules. Again, we're trading similar land. Land for land, both investment purposes. If it's an exchange, right, which is under our sale or other disposition definition, it creates, let's say, a gain. You have to pay tax on it. Well, if you don't have any cash, that might encourage you not to do the transaction. Not good. And again, economically, you had land before, you had land after. Yes, it's not exactly the same land, but economically, you still own the same value land. They're still worth the same, right? Because it's arm's length transaction. So that's what non-recognition rules are all about. They stop that realized gain or loss from being recognized. So you're thinking, okay, this is great. A taxpayer doesn't have to pay gain. Well, one thing to note is that most non-recognition rules apply to both gains and losses. They apply to both gains and losses. You can't have your cake and eat it too. You can't not recognize a gain but recognize a loss under the non-recognition rule, just so you know. It's usually you both occur. To have this rule to actually make economic sense, you have to have both. Okay, now sometimes it's only for gains. You'll see in certain cases it only applies to gains. All right. And there's also ways that you can try to get around it. If you know there's a loss, why not sell the property for cash to somebody and then use that money to buy the land? So if the land downtown, the downtown land, right, had a loss in it. Maybe you bought it during the peak of the market for $500,000 and today it's worth $200,000 and there's a $300,000 realized loss in there. If you sell that loss, guess what? You're going to get to recognize that loss. And you can use those proceeds, that $200,000, to buy the other land that you want, worth $200,000 on the river. Okay? So that's one thing to understand. Another thing to understand is, yes, if a non-recognition rule does apply, then that's good. But non-recognition, this is very important to understand. Please note this. Non-recognition is not an exclusion. Is not an exclusion of gain or loss. It is not an exclusion. Non-recognition is a deferral mechanism. It defers. It defers any gain or loss from being recognized until the future. And how does it do that? Every non-recognition rule has a corresponding adjusted basis rule. So in our previous videos, I mentioned that when you're determining adjusted basis, if you have a non-recognition rule, you're going to have a special adjusted basis rule for that relevant transaction. And that's exactly the case. So what happens is the lurking gain or loss that you don't recognize from the realized gain or loss gets trapped. It's trapped in the adjusted basis. It traps the lurking gain or loss there for later. It's a very interesting technique. But from a taxpayer's standpoint, if you have gain, you want to defer. If you see the previous discussions, I mentioned that taxpayers want to, generally speaking, defer gains and accelerate losses. So that's what this does. It defers gains, defers losses as well. So that's really the basics behind non-recognition rules. Now, there's going to be a third component that we're going to get to in the future, and that's going to be for future videos regarding character of any gain or loss that is recognized. Okay? We're not going to consider character yet. That's for the future. But just note that whenever you have a sale or other disposition, we look at the realized gain or loss, the recognized gain or loss, which that's what's matter. That's what goes on the tax return at the end of the day. Recognized gain or loss goes on the tax return. And then finally, the characterization, if you do recognize any gain or loss, any gain or loss that is on the tax return must have a respective character. Whether it's capital, ordinary, that's going to be something we consider in other videos. Now, the last thing I want to mention are some of the common types of non-recognition rules. So some of the common ones, we saw like-kind exchanges, and there will be a video on that later. Involuntary conversions, there will be a video on that one as well. Involuntary conversions deal with what if your property is destroyed and you get proceeds from the insurance company, or you just get proceeds from that, okay? And you use those proceeds, and you go and you buy, your house gets destroyed in a hurricane, and there's gain on it. And you use those proceeds and you buy a house within a certain period of time. Should you have to recognize gain or loss? Well, the code says no, it's a non-recognition rule. So we'll talk about that. Other common non-recognition rules, if you transfer something between spouses, that's a non-recognition rule. Or separation or divorce, that's a non-recognition rule. So if you separate or divorce and you transfer property and it has gain or loss in it, that's going to be a non-recognition rule that applies. In addition to that, lots of business entity formation. If you form a corporation or a partnership or an LLC, lots of non-recognition rules apply to that as well. There's tons of non-recognition rules out there. There's lots of non-recognition rules that apply to business entities, but there's lots that just apply to individuals and general businesses as well out there. So it's important to understand these non-recognition rules. All right, so I hope you enjoyed this video. Please go through this. Understand what exactly non-recognition rule is. Understand this process, this three-part process. And again, so far, we haven't gotten to step 3, but that will be in a later video. Also understand that this is a deferral mechanism, not an exclusion. and that there's a corresponding adjusted basis rule. So whenever you are looking for a non-recognition rule, you should always be looking for the corresponding basis rule as well.